Hi, welcome to Finance at a Glance. I'm David Faskas. Thank you for joining. There is a problem. You see, most people agree that financial education is key. However, worldwide, only 1 out of 3 adults are financially literate. And this is a problem because there are millions of people who can benefit from a financial education that don't have one. So this got me bent on finding a way to present financial concepts in a new way. It got my gears turning. I mean, surely there had to be a better way to present financial concepts in a way that everyday people can understand and use. Really, that's what made me start Finance at a Glance, an effort to give people the tools and techniques to demystify financial concepts. Robert Schiller put it really well when he said, "Finance is not merely about making money. It's about achieving our deep goals and protecting the fruits of our labor. It's about stewardship and therefore about achieving the good society." Finance should be uplifting. It should help us live life fuller and happier. Unfortunately, finance is often seen as dry and boring. Well, we're going to work to change that. So, what is finance? Well, finance is just money stuff. It involves saving for our goals and planning for our dreams. Carving a path for success for your future and how you want to live. That's finance. I mean, finance connects us all. It connects us across borders and cultures. It shapes the world that we live in. That's finance. So let's take a look at some of the ideas I want to delve into deeper in Finance at a Glance. So one of the first things I want to make a video on in Finance at a Glance is establishing a solid budget. And that's so important because if you don't have a budget, there's a good chance you're living paycheck to paycheck like 8 out of 10 other Americans. We want to get past that. Living paycheck to paycheck can be way more stressful than setting up a simple budget. So I'll give you some tips for how to successfully budget to help with that. The principle couldn't be simpler. You just budget with a series of buckets for each category. You have a housing budget, a food budget, a savings budget, and so on. You just budget every dollar and add up each dollar until it totals your monthly pay. Dave Ramsey says, when you budget, it will feel like you got a raise, which is totally true. Once you build a basic budget, you can feel freer to feature deeper procedures, like saving and investing. One tool that's often used in investing is called dollar cost averaging. And dollar cost averaging is just investing the same dollar amount into the market with a regular schedule over time. It could be investing $100 or some set amount out of every paycheck, or carving a larger amount from a bonus or inheritance into equal pieces. Dollar cost averaging is useful because it can help reduce the risk that you invest in a bad time by spreading your investment over time. However, dollar cost averaging has the downside that it's
technically correct, the best kind of correct.
To invest early to take advantage of more market performance over time. Over time, the stock market rises and falls. These ups and downs are called volatility. When investors are optimistic and the market is rising, it's called a bull market. Usually, a bull market is classified as a period when stocks have risen by 20% or more from a market low. Now, when investors are pessimistic and stocks start dropping without stopping, well, that's a bear market. Usually, a bear market is classified as a time when stocks have dropped by 20% or more from a high, just the opposite of a bull market. And when it comes to the battle of the bulls and the bears, there's one clear winner. I'm going to stop myself before I get in trouble. Let's back up a bit. You see, there's a lot of factors that you have to clarify first when you talk about what the market is. First off, what is the market you're talking about? I mean, most people probably assume this means the stock market, but there are a lot of other markets, like the bond market, the real estate market, commodity market, or foreign exchange market, to name a few. But let's just assume we're talking about the stock market for simplicity. Well, then you have to decide which stock market. US stocks, European stocks, some emerging market stocks. It gets even more complicated than that, though. Because if you choose a country, say the US, well, we've got a lot of different indexes here that represent the US market. Some of you may have heard of the S&P 500 or Dow Jones Industrial Average. There just isn't one consistent way to say what is the US market, or to calculate what a bull and bear market is. To give you an example, I have 3 different sources here, and all show different lengths of time and different average returns for bull and bear markets. And these are all based off the same index, the S&P 500. As of last Wednesday, August 22nd, 2018, the S&P 500 went 3,453 days without a 20% or more decline. That's almost 9.5 years since the Great Recession, and financial news was filled with declarations eager to announce the current bull market as the longest in history. And in my opinion, that's a lot of bull. You see, remember, there are a lot of different indexes and different ways to calculate those. So people who use a different index or calculation might say that the bull market ended a while ago, or that it's still got a ways to go yet. For example, FINRA and Yardeni Research both say the longest bull market lasted 4,494 days. That would mean the current bull market still has about 3 years to go to claim the title as the king of the bulls. But my main beef with that beef, saying we're in the longest bull market in history, that is, isn't the index choice or even the calculation. It's with declaring that we're in the longest bull market when it hasn't been verified yet. You see, a bull market's end is measured by its peak. The current bull market's peak was crested back on January 26th of 2018. If we have a bear market before reaching that point again, the current bull market will lose the crown that was prematurely granted, and it will end only being the second longest bull market in history. It's all about your reference point, and that's just the nature of having an arbitrary and unclear designation like bull and bear markets anyway. They're more often used to sell news than provide meaningful information. So now that you understand a little bit about what a bull and bear market is, let's talk a little bit about the differences between the two. In the past, bull markets have tended to last a lot longer on average than bear markets. I think this chart shows this really well over the past 100 or so years. Bull markets are in blue on top and bear markets in red, and you can see how much longer on average bull markets have lasted. Bear markets have one distinct advantage though, and that is, let's say you invest $100 in the market and it declines in value by half through a bear market. So now it's only worth $50. You lost 50% of your value. How much do you have to gain to get it back up to the 100? It's actually 100% because you were starting from a lower point than whenever you declined. So you have to gain back more as a percentage to get back to where you were whenever you go through a loss. Now, the origin story for the terms bull and bear market is kind of interesting. It's a little unclear where it came from, but it started cropping up around 18th century England, around one of the first bubbles called the South Sea Bubble. So there were middlemen who would sell bear skins to other people that they didn't have yet. They hoped the bear skins would actually go down in value when they actually had to buy them and they'd make a profit. And these guys were called bear skin jobbers. Now, these bear skin jobbers were seen as seedy, shady people, and their dishonest nature gave rise to the phrase, "Don't sell the bearskin before you've killed the bear." So how can you weather those bull and bear markets over time? One way to smooth out those bull and bear markets is to have an appropriate asset allocation. And an asset allocation is just your asset mix. And studies show that an asset allocation can determine 90% of your risk. In the broadest sense, an asset allocation is just your mix of things like stocks and bonds. And having an asset allocation that you're willing to stick with in good times as well as bad is important. The stock market has tended to reward those who had an allocation they could stick with during tough times without abandoning ship. Some of the best market performance has come right after large downturns. Warren Buffett, one of the greatest investors of all time, said the stock market is a device for transferring money from the impatient to the patient. That is why having an appropriate asset allocation is important, and it's something a qualified financial planner can help you pursue. Okay, so you may have heard of stocks and bonds before, but what are they? Well, a stock is also called a share, and that's what it is. It's a share in ownership of a company. You are an owner if you own a share of a company. A bond, on the other hand, is owning debt of a company or government. So if you have a stock, you want the company to be profitable so that the company can distribute profits to you, the owner. So all the day-to-day ups and downs of a stock's price is just changes in what people think they're ultimately going to get paid from the company's profits. Of course, a lot of that day-to-day movement can be just emotional reactions to buying and selling, but the real value, which is called the stock's intrinsic value, comes from its expected cash flows. Of course, estimating those cash flows is a lot easier said than done. On the other hand, when you buy a bond, you're loaning a corporation or a government your money for a while. They pay you interest, and at the end of a predefined term, they give you your money back, called principal. So interest is interesting. Interest rates are one of the key factors that drive bond prices. Interest rates are just based on the supply of money, and when the supply of money increases, interest rates fall. If market interest rates fall, bond prices rise. And if interest rates rise, well, bond prices go down. So you understand all of that? If not, that's fine. We'll take a slower, more in-depth look at a lot of these ideas. But a great way to immensely improve your knowledge and financial plan is to find a qualified financial planner that you trust. A financial planner can be like the motor to your financial machine. I mean, they can help the whole thing run smoothly and efficiently and pull everything together for you. When your financial life seems fuzzy and you have questions, they can help you with some answers. I mean, obviously anything I say in a YouTube video is not a specific recommendation for you. It's a YouTube video. But having a qualified planner can be like low-hanging fruit, and there's someone that can help guide you on your path. Thank you so much for watching this far. I really hope you enjoyed watching this video as much as I enjoyed putting it together. If you have any other finance ideas that you have questions about and want me to discuss in the future, post it in the comments and I'll look at those and maybe make a video in the future about those. I have a ton of ideas I'm so excited to share with you, so please subscribe so you'll be notified when I come out with future videos. I really have to thank PV Productions, who provided the awesome Lego build that I got to build, so be sure to give them a glance and don't miss a chance to advance in finance. And as always, thanks for watching Finance at a Glance.